Likewise, your cameras are switched off by default. This webinar is being recorded, so we will be able to send you the link after the event. And you may ask a question at any time during the webinar by using the chat or the Q&A function in the bottom right-hand corner of your screen. So let's start. I'm joined today by Bernard Delbecq. Bernard is a Senior Director at EFAMA. He's in charge of our Economics and Research Department. He's also overseeing our work in the financial education space, and is leading our work on all pensions-related issues. Also with me this morning is Andreas Stepniczka, who is Deputy Director in charge of sustainable finance, governance, stewardship, but also all retail financial services issues, including disclosures, distribution, and these days, the retail investment strategy proposal of the European Commission. We published a couple of days ago this report, Household Participation in Capital Markets, the author of which is Bernard. So let me turn to you, Bernard, first. You have published this report measuring the level of retail participation, but how do you measure such a level, please?
Yeah, so thank you, Tanguy, and good morning, everyone. So indeed, in this report, we have looked at the financial asset owned by household, and we have basically calculated how much money is held in cash and deposit and how much is invested in capital markets instrument. And in this calculation, we have taken into account the pension savings, the life insurance product, the investment funds, the listed shares, and the debt securities. This means, just to be clear, that we have excluded from the financial wealth of household unlisted shares, so what they own in a company as owners of the company, and also real estate properties. And the reason why we have excluded these two types of financial asset is that because of goal, our goal is just to look at the progress in household investing more in the capital markets and holding less bank deposit. And this is indeed one of the key goals of the CMU. So, Tanguy, just to come back to your question, then, how have we measured this level of retail participation and the progress that has been made? We look at three main indicators. First, the amount of money held in bank deposit. Secondly, the ratio between what is invested in the markets and what is held in deposit. And thirdly, the ratio between the new investment in capital markets and the increase in deposit. And this is well documented in the report.
Well, thank you, Bernard. And starting with the basics, why is increasing retail participation so important?
Yeah, it's important for several reasons, but I would like just to highlight two main reasons. The first one is that the level of retail participation is very low in many European countries. So this means that many households are still putting all their savings into bank deposit. And as we know, these bank deposits are offering low interest rates. And the purchasing power of this bank deposit is declining year on year because of inflation. And on the other hand, it's well documented that by putting some of your savings into the capital markets, you can get a decent real return. So return in real terms over the long term. And this is helping you increasing your financial wealth. It is important because an important issue today in Europe because of aging is that, and it's emphasized by IOPA and the European Commission, I mean, many people risk falling into poverty because they will just lack the adequate income that is needed for them to live in retirement. So you need to complement your public saving, your savings or what you expect from a public pension by saving in the markets. So this is just let's say, the problem and the motivation regarding retail investors. But we also have a motivation regarding the real economy. There is a huge financing need, in particular to finance the green and digital transition. And if people are keeping all their savings into bank deposit, this means that the financing of the economy is highly dependent on bank loans. And we know that with the financial crisis, the great financial crisis, the regulation of banks have been tightened. So there is their constraint on the financing of the real economy. So if people would invest more in the markets, there would be more choice in terms of funding for businesses, and in particular for SMEs and for startup companies. So this macro dimension is also very important. And this is what is recognized also in the CMU initiative taken by the European Commission.
So thank you, Bernard. So you have published this report looking at the level of retail participation over the years. Have you seen an increase of the last 10 years?
I would say not really. This is disappointing. Just to give you just two figures. I mean, the amount of saving that is held in cash and bank deposit, let's do not forget the cash, but it's a small percentage, has increased from around 10 trillion euros in 2015, when the CMU project was launched, to 14 trillion in 2022. And in terms, if you look at the percentage, that means that this amount, 14 trillion, represented 41% of the also financial wealth in 22, compared to 37% in 2015. So we didn't really go in the right direction over the last 10 years.
So not much to rejoice about, right?
Yes, unfortunately, yes, fortunately. And one issue is that still today, most households, they already have, certain amount in bank deposit, and they continue putting a lot of money every year in bank deposit. And I can show you one chart to illustrate, this reality. What you see there, you see in blue, the new amount of money placed in deposit each year. And in orange, you see the amount that households are investing in the capital markets. So what is striking is just to see that these blue bars are quite high. And when you look at what happened in 22, more than $1 trillion, of new money was put in deposit, of course, because of the COVID. But this is just such an impressive amount of money. So from that perspective, yes, I would say that there is not much to rejoice about. But if we want not to be too pessimistic, nevertheless, I like just to highlight maybe two encouraging development that one of which you can see on the chart. You see that in 21 and 22, in orange, the amount that was invested in capital markets, more than each year, 500 billion, was quite larger than the amount that were put in the market in previous years. So this was an encouraging development, partly justified by the fact that you had such a large amount that was invested kept in deposit in 2020. So this is just one positive news. The second news is that some countries have made progress towards greater participation in capital markets. I would like, for instance, to mention Slovakia, Germany, Norway, and actually in the report, we are ranking the European countries in terms of the progress that they have made since 2019, and Slovakia ranked first. So this is explained in the report on the basis of a new methodology using different indicators. But I believe we don't really have time just to discuss that. But I'm available to answer questions today, or if you want to contact me after this webinar.
Thank you, Bernard. Just a reminder for those of you who just joined, feel free to send your questions using the chat room at the bottom right of your screen. You mentioned some countries, Bernard. That's good because, I mean, we know that those EU averages can hide very wide divergences among member states. So if you look at the country level, what can you see?
But you just said it. I mean, there is huge differences, in the way households allocate their savings across Europe. And this is quite visible if you look at the map of Europe, where we see the share of deposit that is share in terms of financial wealth in the different countries that are covered in the study. And you see that in Northern Europe, in particular in Scandinavia, Denmark, the Netherlands, the UK, the share of deposits is quite low compared to the European average. European average is 41%, and you see that in Denmark, only 20% of the wealth, financial wealth, is held in bank deposit. On the other hand, you see the countries that are marked in light orange, darker orange, in Southern Europe, Eastern Europe, I would say with the exception of Hungary there and Italy, you see that the share of deposit is much higher than the European average. In Greece, for instance, 83% of the financial wealth is held in bank deposit. So this is comparing with 20% in Denmark. So it's huge differences. And of course, I mean, between these two groups of countries, you have the countries highlighted in, I would say, more in Western Europe, like in France, in Germany, in Italy. You have a share of deposit that is closer to the European average. So, huge differences across Europe between member states.
And if we look at the green countries, those doing better, I guess, in terms of retail participation in capital markets, I mean, are there some commonalities between those countries?
Yes, I mean, I would like to highlight one key factors there, and this is also shown in this new version of the map, where we see, how much people are saving into pensions product, into pension funds and life insurance products. So if we could show the next, yes, this new version of the map, and you see there that the countries highlighted in green have a significant share of the financial wealth, I mean the household, that is kept into pension plan and life insurance product. For instance, 69% in the Netherlands, 60% in the UK. This is very different and from what you see in the countries that are highlighted in orange, where this portion that is saved in pensions product is very low. So I would say that there, we may come back to this later in the discussion, but pension savings is a key driver to greater participation in capital markets.
Well, thank you, Bernard. This is very, very interesting data and very, very good stuff. And I think the report, I mean, one of the added values of the report is precisely all those country breakdowns. So I would really highly recommend today's participants to take a look at the report, which is available on our website. You mentioned some statistics, but we also know that at national level, national statistics can hide divergences. Can you say a few words about this, Bernard?
Yeah, I mean, it's more, I would say, criticism that you can make when you're using averages. We have seen that, and I mentioned the 41%, which is the average of the deposit that is held in in bank deposits, so financial wealth that is held in bank deposit, 41%. But we have seen huge differences, across countries. And actually, this is also true when you look at a single country. The average for Sweden or for Belgium hide wide differences within the population of the country. And another finding of the report that is also based on data from DCB, a survey made by DCB, shows that actually most households in many European countries are not investing at all in capital markets. So this is another good reason for member states, for the European Union, just to give greater emphasis on the need for people to save in the markets.
Thank you. I think it's quite concerning also in terms of, wealth inequalities, which may be growing in many of our countries, precisely because there is such a gap between those who are holding financial instruments, which is a minority, and the rest of the population. Maybe turning now to you, Andreas, and apologies for this kind of all-male panel today. We do have more female in the EFAMA staff. We have, I think, 60% of female colleagues in total. But today is not the case. Andreas, as I said, you are responsible, among other things, for our work on the retail investment strategy proposal of the Commission. My first question to you would be, will the risk increase retail participation? Yes or no? And if not, why? And if so, how?
I don't want to sound too pessimistic right off the bat, but honestly, I think we're doubtful that the risk can actually increase retail participation. But maybe, time to take a step back. I think Bernard has rightly explained that, retail investors do not save enough. What is interesting is that I think we all, so let's say legislators, financial regulators, financial industry, we all agree that we need to invest more money in the long term, as Bernard has explained that. What is interesting, though, is that our starting points are quite different. So what we see from the European Commission is kind of like the narrative goes a little bit like this. They say it's crystal clear that investors currently receive a bad deal when they're investing. Also, investors are aware of this. So therefore, because they have this bad deal, that they know that it's mainly due to too high costs, which reduce the returns. So the logic of the Commission then is, if you are lowering the costs sufficiently, investors will see that the potential that is there and start investing. Our starting point is a bit different. At least when we talk about funds here, we believe that most of our funds actually provide a reasonably good return after costs and inflation. So ESMA is also doing this annual cost and performance report. So if you look at them, they calculated that an average retail investor that invests into an average UCITS fund actually receives 50% net returns after 10 years, 35% when you actually include inflation, which is outside of our realm. But given that we believe we're providing value to investors, it's more than for us to question, why don't people invest or citizens invest more? Why is it still that there is still savings? So there is this gap that needs to be bridged. For us, it's simply the unfortunate fact retail investors will not wake up one day to the next and decide they need to find the best UCITS fund for them. So this means you have to, as I said, kind of create this kind of like link, this bridge, and that usually is with investment advice. That's also something that is part of the retail investment strategy. So you see there is quite some diverging starting points, but what this means then is from the Commission's vantage point, because they believe it's mostly a bad deal, they are prioritizing or putting pressure, mostly cost pressure on the financial industry, both on lowering existing costs, but also for creating more opportunities for low-cost products. So in a sense, it means they are prioritizing the already existing investors and trying to give them a better deal. For us, we kind of see more that there is this untapped potential for all the not yet investors, and therefore it's this question, how do you bring them more into the fold?
So you talked quite a bit about costs.
Mm-hmm.
Is cost a main driver when it comes to retail or citizens investing in capital markets instruments?
Of course, cost is an important driver. But I think what's important is that it's not the main driver, and maybe also important to explain that a bit. What is also interesting when the European Commission explained the retail investment strategy, they like to quote this the Eurobarometer research that they had and said EU citizens do not invest because it's too costly. If you look at the report, it's also quite interesting and shows you that the situation is a bit more complex. They are right that there is, I think it was 12% of respondents that said they do not trust investment advice. And there was 15% that said they're not confident that they will receive sufficient returns. So you could make the argument that this is also, of course, connected to costs. and therefore they're not investing. What is interesting and wasn't mentioned though is the other respondents that we had. So most of the people actually said, and this was almost half of them, said they do not have sufficient money to invest. Much less than was, I think, 21% that kind of said they have concerns about the risks of actually investing. And 14% found it actually just simply too complex to invest. So, so I think this kind of showcases that it's a much more multifaceted problem that we have to solve. Cost is one of them, but not the only one. That kind of brings me a little bit to, because it's also one of those main pillars of the retail investment strategy, is this idea about providing value for money. So kind of like what I think is important in the whole thing is that, you know, you need to focus on outcomes and net returns rather than just looking at cost in isolation. Of course, you also need to understand that the costs are there for you to actually be able to allow to invest. So it's not that you just simply can invest without any costs being there. So in a way, the Commission in this respect has the right notion when it kind of said, okay, maybe we should look at this whole thing about value for money, try and provide added value to investors. And I think they're right. So in a sense, it makes sense that you look at the whole financial value chain, you know, from us as product manufacturers all the way down to distribution chains, financial advisors, and make sure that at the end there is value for the investor. But that's where it becomes interesting, because how do you define value? Again, for the Commission, it's, I think, mostly they've come up with this idea of saying, okay, we're creating those performance and cost benchmarks. We're creating EU-wide benchmarks that we have set up. But if you look at it in detail, we very much kind of like are afraid that this is just about costs. You're trying to group different products, and then you see if there are outliers. Those are more or less simply, you know, disappearing from the market. So that kind of means in a way there's a lot of unintended costs. It's a very complex system. There's a potential more or less quote unquote for price caps that in the end will probably reduce the competition that's there and also therefore reduce investors' choice. I don't, as I said at the start, you know, we don't want to be too critical on this. And I think, as I said, the Commission is on the right track there. But I think there is an alternative way in how you can actually get there. So I think there is a couple of things you need to consider. I think one of them is quantitative factors, of course. They're very important, but there's qualitative ones as well. So like sustainability, you know, it's important to take this into consideration as well, but it's not the normal metrics that we are using. Instead of maybe starting with a very complex system that is there and creating EU benchmarks and giving ESMA and EIOPA this kind of very huge task to come up with them, maybe there is a need for like a more slower natural approach, which kind of means maybe you start in kind of requiring all those different members of the value chain to create a value for money policy, ask them to kind of like test themselves against peer groups. Those tests, as well as the value for money policy, then need to be given to the NCAs, so they can, that bit by bit, we can ensure that they're all testing themselves against the right peer groups, and that there is in itself, in the end, value for the end investors.
Thank you, Andreas. Yes, I think that when it comes to value for money, it's very important that if we follow this approach, and we are supportive of that approach in principle at EFAMA, that this approach applies along the whole value chain, as you mentioned. You refer to financial advisors. I know that at EFAMA we stress the importance of access to affordable and quality advice. Is it not already the case? And why is advice so important?
You know, when I mentioned this Eurobarometer report, you kind of see that there is simply this gap that even if people have money to invest, they do not know how to do so. They're afraid that that it's simply too risky to do so. So how do you make this happen? That you can actually incentivize people to invest. I think part of what Bernard has already explained. It shows you how you can achieve that. So that could be through pension systems, tax incentives. We've seen great examples there. However, that's outside of the EU's powers. So therefore, they are focusing here on investment advice. And because that's then the main venue of how you can try and bridge that gap. You're right. There is already two different possibilities in how retail investors or investors can pay for advice. So it's either through an upfront fee that you're paying, so this kind of so-called fee-paying advice, or that you're paying it through inducements, or in a maybe easier term, kind of saying you pay them back in installments. What's interesting is that because investment advice is given by distributors and banks, so this model of inducements is well established. And mostly also in continental Europe, this is how retail investors pay for advice. In one way, it's beneficial because it allows all types of citizens to be able to get investment advice, as they're paying an annual percentage of the investments rather than paying, I don't know, 180 or 200 euros upfront for advice. However, as long as this model has existed, there has been ongoing criticism that this, because the advisors are being paid by distributors, this will inherently lead to biased advice. Financial advisors will only look at products that maximize their own profits and not act in the best interests of clients. So as I said, this discussion has been going on for decades. There is a lot of very stringent rules around those conflicts of interests, but this criticism has never died down. So it's also part of the ongoing PRIPS debate, where the Commission had initially considered to actually outright ban inducements. In the proposal that they've put forward, this wasn't the case, but there are still some parts of the co-legislators that are saying they don't find this enough and they want to bring this discussion back to the table. Why we think this is important? It's simply, as I said before, we need to consider, how do we bridge that gap? How do we get people to invest and alleviate their fears that they're not gambling, but they're investing in the long term? So that means, instead of just trying to find the most efficient way, which probably is people investing without investment advice and just investing into ETFs, which has to find a middle ground where it is that people who are already very acquainted with the bank advisors, which are very much the venue that they go to, that they are also being allowed to give them advice on products. Of course, we talked about costs before. This has a cost as well, so it's not for free. And there, I think the discussion really in the risk should be more about what is the value for society as a whole, that we have this additional service that should provide value.
Thank you, Andreas. We also have those ESG preference requirements, right, under MiFID II, with notions such as taxonomy alignment, sustainable investments, PAIs, something that I guess the majority of people out there have no clue about. Does it make the case for advice even stronger?
Absolutely. There's no doubt about it. With all those different dimensions, and I think we are also not in a great place in how we try to bridge the gap between sustainable finance and retail investors in the language that we're using. You're talking yourself about taxonomy alignment and stuff. I mean, the normal retail investor doesn't understand any of that. So therefore, it's even more important that you have this advice, that there is someone that can try and explain in layman's terms what those products intend to do. So I think this is also something, and it's a criticism from our side as well, that it's interesting that there is so much focus about costs, and all those discussions about sustainable finance that we had over the last couple of years are somewhat just not reflected in there.
Thank you, Andreas. Bernard, going back to you and your report, you have identified some interesting correlations between the level of retail participation in member states and some other elements. Can you tell us more? You're on mute.
Yes, thank you. Yes, indeed, we have identified a high degree of correlation between the level of retail participation at the national level and a number of factors, determinant. And I can illustrate this by showing a few charts. So on this one, what you see again, I mean, that's a confirmation of what I said earlier, that one of the most important factors that can explain the degree of retail participation in the markets is the extent to which households save in pension funds and life insurance products. The 5 countries, shown in green, the Netherlands, Denmark, UK, Sweden, Norway, are those with the lowest share of deposit. But you see, they are just at the bottom of the, and on the right-hand side, because in terms of savings in pension fund life insurance per capita, they are just far, to the right side. So retirement saving is a very important factors. There is this correlation, but it's not the only one. We found also a good correlation between what you see here on the next chart, between the public pension, yes, and the participation capital market. So you see on the right-hand side, Spain, Portugal, Greece. The replacement rate of public pension today is quite high. I mean, in Spain, it would be just close to 80%. So you probably have in those countries, you have a population that trusts that in terms of the pension savings and the access to a good pension in retirement, they can trust the state. And therefore, they may favor more, consumption or deposit than taking the risk of going into the capital markets because they don't feel the need to save as much for retirement. On the other hand, if you see at the top of this chart, 3 countries, the Netherlands, Sweden, Denmark, where people are investing a lot in the capital markets and get nice return. We need just to, think about this outcome that Andreas mentioned, the return, the performance of this saving. It could be, that's one explanation also why those countries are at this position in the chart, is that the replacement rate of the public pension is rather low. Now, there is also a correlation between the share of deposit and the financial wealth per capita. So again, on the right-hand side, you see these green countries where people, household on average, have a rather high financial wealth per capita. And this may explain, this may be another reason why those households, those countries, in terms of their financial wealth, are holding less money in bank deposit. On the other hand, you see that the countries that are highlighted in red, in those countries, the share of deposit is at least 70% of the financial wealth. And those are countries, you look at the chart, those are countries where on average household have a lower level of financial wealth. The reason, I think it's obvious, right? People need enough money just to manage their everyday spending. And therefore, it's only after they have reached this kind of minimum amount of money just to consume that they can start thinking about going into the financial market. So these mean also that we cannot expect that suddenly some measure in those countries on the left-hand side would solve all the problem and ensure a much higher retail participation in the capital markets. So this participation in capital market will have to go together with an increase in economic development and in improved living standards. This is what we hope. But it will take more time, of course, and this explains also the differences between countries that we have highlighted before. And the last correlation that we see is between the level of financial literacy and the deposit holdings. Again, the countries on the right-hand side in green are investing a lot in the capital markets, and those are countries where survey shows that households score well in terms of financial knowledge. Netherlands, Denmark, Sweden. And on the other hand, again, the same 10 countries at the top, you see that in these cases, most of the countries, I would say with the exception of Slovenia on the right-hand side, have or tend to have on average a low financial knowledge score. And they are investing less in the markets. Now, I mean, this is not surprising. If people don't understand the benefit of asset diversification, the impact of inflation on their savings, to be even a little bit more sophisticated, but it's so important, the law of compound interest rate. If people don't understand that, I mean, we believe that they don't see why they should invest in capital markets. So there is also a huge effort that needs to be made in the area of financial literacy to explain why people should save more in the capital markets.
Thank you, Bernard. I would like to come back to this issue of costs, which we discussed with Andreas a moment ago. I think, Andreas, you were telling us that, in effect, cheap does not mean valuable. But you, Bernard, you did some research on the cost of usage. Can you tell us more about this research?
Yes, I mean, yeah, we could have a webinar to discuss this issue. But let's say I would like to briefly maybe highlight 3 dimensions, that come out from our research. First is that the cost of usage have been declining for many years and every year. ESMA has confirmed this in its recent report on the cost and performance of usage that was published at the end of December. So costs are declining. And the reason is simple. There is competition in the market, in particular between actively managed funds and ETFs. I mean, we all know that ETFs are less expensive, and this difference in cost is forcing fund managers to reduce their fees, especially if they want to attract new clients when they launch new funds. So that's a key driver, and it is indeed the fact that new funds are, cheaper than existing funds. And the measure that have been put in place, implemented for many years to include the disclosure of funds, and we welcome that, as long as people can understand these. But the industry understand that there is a disclosure on cost, and this is putting pressure on the fees. So this is just the first remark to explain why costs are declining. My second remark is that there are too many studies, analyses about the cost of usage that are very critical about the industry, but often they don't compare apples to apples. And I give you just an example. I mean, as I said, ETFs are a good product. They are less expensive. We have many members that are managing ETFs, and this is a good thing. But if you compare the cost of ETFs with the cost of active funds, one key difference is that the ETFs are sold on stock exchanges without advice. And as Andrea said, advice is something that is costly, makes sense, right? So, and most active funds are sold with advice, and therefore their fees are higher. And this is a dimension, of the analysis of the cost that is often underestimated. I would even say that to add on these, that we show in one of our market insight that in the United States, on average, the cost of mutual funds are lower than in Europe. But most of the data now that are available on the cost of mutual funds in the US exclude the cost of distribution. They are not included in the cost. They are put aside. And often there in the United States, many households that are saving on their own in mutual funds pay an advisor, and the cost of these advisors should be integrated in a fair analysis that would compare the cost of UCITS and the cost of US mutual funds. And if I may, Tanguy, my third remark, as Andreas said, there is too much emphasis on cost. So sorry, just to stress again this point, but one way also to, just to explain why, this is not fair just to, or useful to put so much emphasis on cost is that what matters for investors that are saving in the capital markets, it's about the performance. It's about the risk-adjusted returns. It's how much you're going to get more compared to bank deposit. And what is interesting is that when you are comparing the cost of UCITS, active funds, and ETFs, the difference between the cost of those funds is very small compared to the difference of the performances that those funds, if you look at a large sample of funds or sectors are doing. So investors should pay more attention to the performance of funds and to understand and to be, to understand and to invest smartly. Again, for many investors, advice is quite important.
Thank you, Bernard, and thank you to those of you who have already asked some questions using the Q&A and chat room. I think actually, Bernard, 2 of those questions are for you. Going back to you, Andreas, Bernard briefly touched upon this disclosure issue. Now, it strikes me that there is really a need to simplify significantly some of those disclosures, which I find super complex. And research shows that what is perceived as complex is usually deemed risky. And since we are talking about the cost of UCITS, do investors understand these disclosures? What's your view?
It's an interesting and tough one. I mean, I'm working on disclosures for well over a decade, and I don't think we've actually gotten closer to what we want to achieve with that. So I do think we do need quite a different approach in terms of disclosures, and particularly through retail investors. I think one of the issues is that we've never really thought about the target audience. What I want to see with this, yes, there's going to be, I'll talk about the PRIP kit in a second, but because of the information asymmetry that is there, you're always trying to say, okay, you need to put a little bit more information in there to make sure that retail investors understand. Unfortunately, we always land up in a place where we say that we need more disclosures and more disclosures, where in the end, those are not particularly even targeted at the retail investors, but maybe have some other ideas or purposes, let's say, for regulators to understand. Bernard was talking, about fund costs, where ESMA is using the UCITS kits to do that. So in a way, then, we always seem to end up in a place where we have information overload. And I think we simply, always seem to greatly over-exaggerate the amount of time people are willing to look at those documents. I mentioned the PRIP kit before. It took, I think, a good decade to come up with this 3-page document that we now have. And what you see, the experience some of our members have, if some of their funds are sold online, and you actually have to say that, tick the box that you have read those documents. Sometimes the average time is about 3 seconds. Either this means retail investors are much faster readers than we think, or it simply means they see this as a tick the box exercise. So Bernard also talked about financial literacy and stuff, but in the end, we are not achieving the goal of what we want to do with that. Of course, it's a tricky process. I agree. There's, different pros and cons that you have to weigh on this, but I don't think we're hitting the right mark on this.
Thank you, Andreas. We know that the risk proposal of the Commission contains some elements regarding digital disclosures. I mean, will this be a game changer?
Okay, maybe game changer is a bit too ambitious, but I certainly think it goes in the right direction. It's still very high level, but I mean, at least, all those discussions that we always had with paper-based disclosures. So let's take the PRIP kit, for example, again, 3 pages. you want to have more information, but you are then hitting this kind of limit of 3 pages. So what do you do then with the whole issue of ESG disclosures that are not yet in there? Then you have to add another piece. So what do you throw out? So in a way, then digital disclosure should really help us with this, because on one hand you can have this kind of idea about layering. So you show the first level or layer, and then if people really want to see, so let's say you're showing them an all-in cost, but if they really want to see what those individual cost elements are, they can click on it, but they're not being presented with one huge table where they don't know what they should even start with. The second one, I think as well, is this idea that you can, rather than having some preconceived notions of disclosures, you could use them to kind of make it more accessible to the individual investors. What I want to say is, if you do have cost data or performance data through the right websites, you could say, okay, what would have happened to this product during the financial crisis or during COVID and stuff like this. So it allows you, and just not kind of saying this is the right way in how you have to present data, it can make it a bit more dynamic. So hopefully that can kind of then relate to investors and allow them to also try to make the right choices. But of course, look, it's very technical, devil's in the detail, but it's most certainly an attempt that we should try.
Thank you, Andreas. Bernard, going back to some of the charts you showed us and the green countries. So clearly some member states are doing better than others when it comes to retail participation. Does that mean that the current top-down approach of the Commission, of the institutions, should be complemented by a bottom-up approach?
Yes, fully agree. And I would say that the bottom-up approach is more important, in the context of trying to improve the retail participation. I mean, this is certainly one key conclusion of the report, because, as I've already emphasized, I mean, there are 3 main factors behind the level of retail participation: the national pension system, the level of financial literacy, and tax incentive. I mean, we that are available for investment. And we haven't yet talked about this matter, I mean, so far, but clearly this is one of the key also factors that can convince people to save more in the markets and to save more for retirement. Now, these 3 policy areas fall under the responsibility of member states. And even in some member states, this responsibility falls at the level of the regions. So, yeah, I would like to say, unfortunately, there is a limit to how much Europe can do. And this is one reason why our recommendations are mostly directed to member states.
Can you be more explicit on that?
Yeah, I mean, at the end of the report, we developed indeed, we make a number of recommendations, and unsurprisingly, the key recommendation is to encourage member states to develop funded pensions to complement the first pillar pension. It is not by chance that Sweden, which I mentioned already a few times, is well ranked in this report. It is because the authorities long ago took measures to encourage retirement savings. And one of these measures is the obligation for people to invest 2.5% of their salary in investment funds to complement their public pension. So this is the mandatory approach to pension savings that was adopted in Sweden around 1999. And after 25 years, of course, many Swedish households have built a nice pot, to complement the pension savings. And a pot that's interesting, there is just data that show also the return, that this money invested at compared to the return that people got by with their contribution that they made to have their public pension in Sweden. So this is one approach. Not many governments, are keen to take this measure. There is an alternative approach that we recommend. This is also recommended by EIOPA, is to automatically enroll employees in firms into occupational pension scheme, unless they want to opt out. But if you automatically enroll, you avoid the inertia that characterize, the behavior of many people. And to opt out, they have to take, an action that inertia prevent them to take. So on average, this is a very smart way of encouraging people to save for retirement and therefore to save in the market. This is called auto-enrollment. Now, there is also, I would say, effort that should be made to increase the disclosure about the income that people can expect to receive when they retired. Just addressing myself to the audience. Think about this question. Would you know how much you're going to get from your first pillar pension, your second pillar pension when you retired? And I think many of you would not be able to have a clear view. And it's quite important to know whether you're going to get 3,000 euro, 5,000, or or less. And there is a way to provide this information to the public. The tool is called Pension Tracking System. And of course, if people, and this is the case like in Belgium, if you know how much you're going to get, and it's only 2,000 euro, and your standard of living is, spending 3,000 euro per year, you need to adjust your saving, and you need to save more. And again, if you want to get some return in the market, to build up and to ensure an adequate retirement income. So this is at the European level. And quickly, two measures that we suggest at the European level. One is to review quickly the PEP regulation, the Pan-European Personal Pensions Product Regulation, which is a failure. There's only one provider today in the market. We spend years negotiating, or member states, the European Parliament, the Commission, spend years to develop this regulation. And unfortunately, there is just only one provider today. So there is an urgency to address the problem, explaining the failure of the PEP, and in particular the FICAP. And we know as a fact that EIOPA is ready to engage into this field, but needs a request from the European Commission. So we hope that the European Commission, if not in the coming weeks or months, when the new Commission is in place, will ask an urgent review of the PEP regulation. And my last...
yes, last, because I'm conscious that we are running out of time. So maybe a last point.
Stop here.
No, okay, thank you, Andreas, because we have received quite a few questions, and I would like to address those. Andreas, before we look at those questions, any final comments on your side?
Just that I don't want to sound too negative on the risk, So I think our comments come in a place where we wanted to succeed. We have altruistic motives for people investing more, because this is also going to be good for our industry. And a lot of the things that I've mentioned, are in essence the right questions to ask. Already talked about digital disclosures, access to investment advice, value for money. So all this is very good. Maybe two more points. Also, this alignment between investment and insurance products. I think it's something that the Commission is trying to push, and it's important because retail investors simply don't understand, the legal wrappers that exist around them. Financial literacy, we mentioned as well. So again, good that the Commission is trying to, have an emphasis on that as well. So just wanting to kind of try to set the scene at the very end.
Thank you, Andreas. Thank you, Bernard. Just looking, and thank you to all who ask questions using the Q&A and the chat rooms. Maybe turning first to the Q&A room. Two questions here, probably addressed to you, Bernard. Let me read them out. Your report, Bernard, ends in 2022. How do you think the experience of inflation and higher bank deposit rates will affect allocation of savings? Clearly, people are risk averse. Having higher interest rates on bank deposits means maybe more competition for our own products. People may be staying more in bank deposits than investing in markets. Any view, shortly?
Yeah, I mean, yes, it's the case, and we plan to have a short update of this report integrity in 23, by the summer. It's true that the interest rate has increased, not so much on bank deposit, but still, this is a good news, and also on bonds. But still, the experience, I mean, shows that if you want to invest for the long term, and this is what is about, retirement savings, then going into the markets, but investing in bonds is going into the markets is a good thing. And you're always going just to beat, deposit rates because those are safe product in principle, and therefore there is no risk premium. But the risk premium, you can just benefit from it if you invest for the long term. So more competition, but the message remains the same. You should diversify it into the markets.
Thank you. Another question probably for you, Bernard. Did you find any differences in terms of age of participants in capital markets?
We don't have data on this. This is a good question. We don't have data. I would assume, just thinking quickly, that as again, you need to have a minimum level of financial wealth before being able just to invest in the market for the long term. So I would assume there that at least the older generation have more financial power to invest in the market. On the other hand, it is also possible that the young generation that is just use social media, digital tools, and so on, are more keen, just to go into the market. So it's an interesting question. Maybe we will need to investigate that and to see what the ECB has in terms of data in that. Thank you.
Thank you. Another question. Did you explore the impact of the German ETF savings plan on investment levels in Germany? And are there lessons other nations could learn from this?
Good question. No, we haven't explored, but it's a good suggestion. So we can certainly look at that in particular also with our, German member, BVI. I take this opportunity also just to say that in the report, there is a lot of example of action taken at the member state level to improve retail participation. And that could be then a source also of, let's say, of a better understanding of good practices. So this is, we haven't discussed that, but, it's a major part also of the report, what has been done at the national level.
And if I may add, following that question on German ETF savings plan, my understanding is that ETF are becoming more and more popular in Germany. And I think that in terms of lessons that could be learned from this, well, one such lesson could be that, you don't need regulation to make it happen. It's a natural thing. You don't need a top-down effort at the EU level to force people into those products. I think we do have some good experience recently, especially in Germany, and I think that maybe there is a lesson to be learned from that perspective. Another question.
But if I may add,
yes, please.
I mean, what we have seen in 23 is that the new money being invested in UCITS went to ETFs. And a lot of money was withdrawn from active funds. So the switch towards ETFs is on the way already. So this supports your point that the information about ETFs is available and is driving some new investment into this segment of the market. But again, as I said, in general, investors doing that, they may be institutional, so they know what they are doing. But if you're retail investors, you don't have advice in general when you are buying ETFs.
Thank you. Conscious of time, maybe taking a last question regarding the cost of new funds or more recent funds compared to the cost of, say, older funds. ESMA data, and also I think EFAMA data shows that more recent funds tend to be less expensive. Is there a valid explanation for that? Bernard or Andreas?
Yeah, I mean, yeah, there is a bit of inertia in the market, of course. As I said, there is competition, you know, from the cheaper funds like ETFs, and if a fund manager needs to create a new funds like an ESG funds and wants to attract money and new clients and don't have a track record, I mean, they need just to put more emphasis on the fees. But in general, I mean, we see also that the fees of existing funds are declining less fastly for the reason just explained, but they are also declining.
Thank you very much, Bernard, Andreas, for your participation in this webinar. Thank you for those of you who attended it, asked questions. Let me basically conclude by saying that, you know, really, we should be talking about these retirement savings gaps much more than is currently the case. We keep talking about this dual transition, you know, environment, digital, but there is also a third pillar, which would be this demographic transition and the increasing retirement savings gap. If nothing is done at member states level, I think we can reasonably fear that this will lead eventually to social unrest, which could weaken our democracies and even weaken, you know, further down the line the EU project. And that's why EFAMA has launched this European Retirement Week together with Pensions Europe and Insurance Europe, and then we were joined later on by a number of other EU trades. So thank you, everyone. This webinar has been recorded, as I mentioned at the start, so you will be provided with the link to the video. I wish you a good day, and my thanks also to my colleagues Miriam and Haley, who have prepared with us this webinar. See you next time. Bye-bye.
Thank you very much.
Thank you. Bye-bye.